Now we would like to begin our seminar. Good afternoon. Today we talk about climate change in Japan, Inc. How should boardroom oversee transition risks? From NRI, we have Ms. Mitsui. From Market Force, we have Will. And we also have Mr. Fujisawa from RectusPartners and Mr. Algirdas from TPI. Just briefly, for your information, I'd like to introduce Proxy Watcher. Listed companies and shareholders, stakeholders, we are providing engagement support between these players. It's not just stakeholders engagement with companies. We are providing training and lectures to the board members of different companies. Responsible seminar series will start in June on TV and radio. We're working with Manex Securities. We also provide similar webinar series. RI Japan event, we participated. And just want to give you a housekeeping announcement. We have translation service available. Please find appropriate language, either Japanese or English. Choose the language of your preference. So at the end of the event, we provide Q&A session. Please utilize Q&A chat at the bottom of the screen. Please write down your questions to the panelists. Identify to whom you're asking questions. Theme for today is just transition. This will be one of the themes discussed for shareholders' proposals. I'd like to invite Mr. Algirdas Brochard from TPI to discuss transition happening in different countries, and will talk about shareholders' proposals. And Mr. Fujisawa, who became independent from financial institution, will talk about board of directors of listed companies, how they should manage transition risk. And lastly, Ms. Mitsui is going to give us a summary as to how shareholders engagement is done for listed companies. What are some of the challenges? So that's the whole structure of the webinar. So I'd like to invite Mr. Algirdas Brochard to start.
Thank you very much indeed, Ko, and thank you, and good morning from me here in London. So my name is Algirdas Brochard. I'm part of the Transition Pathway Initiative Center based at the London School of Economics. And today I'm going to set a little bit of a background scene, who we are, what we do, and then I'm going to deep dive into two specific areas of the framework. So can we have the next slide, please? Next slide again. So just to tell a little bit about who we are. So we are the Transition Pathway Initiative Center based at the London School of Economics in London. We are an independent source of research and data into the progress made by corporate and sovereign entities into the transition to a low carbon economy. We have detailed and transparent methodologies to assess these entities and to monitor the transition pathway trajectories and net zero alignment. We are open access, so all of our data is publicly available. And we also the research partner of TPI Limited, which is a global asset owner-led initiative. At the bottom of the slide, you can see the project that we have here at the TPI Center. And today we're going to focus on the banking project. Next slide, please. So just to tell you a little bit more about our coverage. So we are assessing 26 large international banks and 12 US regional banks. And the US regional banks is a project that we launched this year. And for Japan, we're specifically covering MUFG, Mitsuo, and SMBC, as you can see on the bottom right of the screen. Next slide, please. So just to explain a little bit our framework and how it works, I'm going to focus more today on the qualitative assessment part. But if you're interested into the quantitative assessment and you want to understand more about our framework, I encourage you to go to transitionpathwayinitiative.org for more information. So how does the qualitative assessment part of our framework work? Well, we have 72 sub-indicators, so those are questions. And we looked at publicly information of the bank, and we score banks yes or no on these questions. Those 72 questions are divided into 10 areas that you can see on the left-hand side of the screen here. And today, I'm going to specifically deep dive into two of these areas. One is climate governance, and the second is the just transition. Again, if you're interested into knowing more about other areas, I would encourage you to have a look on our website. Next slide, please. So just to explain a little bit about how a framework is organized. So we have the overarching area. So here, for instance, it's climate governance. Then we have an indicator that sort of sets the seed into what is it that we're trying to achieve here. So for instance, if we take the example of indicator 8.2, it's whether the bank has nominated a board member or board committee with explicit responsibility for oversight of the climate change strategy. And then on the right-hand side of the screen, we can see the sub-indicators. So these are the actual questions where we look at the publicly information that the bank disclose. And on each of these questions, so these three questions that you can see on the right-hand side here, we score banks yes or no. There's a logic to it. So the sub-indicators are designed to be increasingly stringent and therefore increasingly hard to meet. So if we take on the first indicator here, 8.2.a, it's whether the bank has disclosed evidence of a board committee or board member that has responsibility for oversight of climate change. Second is a little bit more stringent and ask whether the bank has assessed these individuals' competencies to manage climate risk and whether it has disclosed the results of these assessments. And 8.2.c is whether the bank has disclosed details on the criteria it uses to assess the board competencies. So as you can see, it's designed in a modular way to really understand banks' progress in the transition to net zero, such as it's easier to meet the first one and then increasingly stringent criteria. So if we go to the next slide, please. So if we deep dive onto this governance indicator that we just talked about earlier, so just the rationale behind it is to ensure that the banks have established a clear line of accountability for climate change. And if we look at the results of last year, we can see that actually no bank scored on the two most stringent governance criteria. This is not to say that they're less important than the ones where they did meet, far from it. But last year, only 22 banks met the criteria for these indicators. And we're currently in the process of assessing banks for this year. And the way that we do is that, as I mentioned before, we look at public information data. Then we send it actually to the banks for them to see if there's additional disclosure that we didn't see, for instance. We then incorporate this information and then we publish the results around September, October. So we can see that last year, 4 banks did not meet these criteria. So we can see that MItsui and SMBC had published disclosure that indicated a clear link that the board had oversight of the climate risk. However, in the case of MUFG, what we saw is that the person at the executive level that was responsible for climate change didn't report directly to the board, and it wasn't clear how the board was supervising climate risk in this instance. And that's why last year, the bank did not score on this indicator. Every year, the assessments are independent from last year. So this year, we're reassessing all of these banks completely independently on last year's results. Then if we go to the next slide, please. And this is going to be my final slide for today. Very happy to delve into the framework a little bit more in the Q&A session. But I just wanted to deep dive also in the just transition. And this is an area where that is in constant evolution, and we've refined the indicators slightly compared to last year. That's why the results that you see this year might be different from the results from last year. But basically, the purpose of these indicators, 9.1.A, is to see whether the bank has committed to decarbonize in line with defined just transition principle. And there's two ways that the bank can do this. First is at the group level, if it explicitly commits to decarbonize in line with the just transition approach. We saw this year that banks such as Crédit Agricole came close to it, where they use language such as support the transition to carbon neutrality for as many people as possible, but that is stopped short of a firm commitment. And the second way that the banks can meet these criteria is if they explicitly incorporate just transition consideration in business activities covered by the bank's decarbonization strategy. So in this case, we saw that HSBC assessed how just transition principles are addressed in its customer transition plan. That's for some, but not all of those sectors. And they do have common but differentiated policy parameters for customers outside of the EU and the OECD. Finally, 9.1.B, the rationale behind this is to see whether the bank has already taken action to incorporate just transition principles. So if we take the example of Barclays, in the latest annual report, they disclosed an action where they partner with British Gas to launch a pilot to support customers experiencing low financial well-being in accessing support with their energy bills. So that's sort of a direct example of a just transition action. And last word for me concerning Japanese banks and the just transition. We have so far not seen overall commitment from Japanese banks to decarbonize in line with just transition principle. The language that we saw was a little bit more around aiming rather than commitment. And in terms of action, we saw that they were participating in the Vietnam JEP. That's the Just Energy Transition Partnership. But it wasn't very clear what the specific role was in this. So they didn't score last year on this indicator, and we'll be reviewing them for this year. But I just wanted to show you the example of just transition action that banks can disclose. Very happy to pick any of these teams up in the Q&A later on. But for now, in the interest of time, I will stop here. Go back to you.
Thank you, Algirdas. And I'll speak from Japanese from here, actually. アルキリザさん、ありがとうございました。資料ですね、すごく
Algirdas-san, thank you very much. That the materials is very intriguing, and for the details, well, all the information was not included, so that in the slide that we have the storage, we store the slides, and anybody who are interested, let us know that we can share the slides with you. Next, on the same theme, that we would like to assess that the financial institutions and also their disclosure of the market, that we would like to have the specific.
Thank you, Ko. It's wonderful to be presenting to you all. Thank you for joining. My name is Will van der Pol. I am the CEO of Market Forces. Market Forces is a not-for-profit environmental advocacy organisation, which was founded in Australia 11 years ago now. But our work has increasingly focused on Asia and Japan in particular, as we seek to shift finance and investment away from environmentally damaging activities, particularly the expansion of the fossil fuel sector, and instead direct finance and investment towards activities that enhance and protect the environment, particularly driving solutions to global problems like climate change. I'm here today to mostly talk about the shareholder proposals that Market Forces has filed with the 3 Japanese megabanks, so MUFG, SMBC, and Mitsuho, as well as a proposal filed at Chubu Electric. Market Forces, part of our sort of work towards our mission, focuses on shareholder action. So we work with shareholders and institutional investors to encourage better climate action from the companies that they invest in, for the purpose of delivering a better climate outcome for the world, but also better portfolio performance for investors whose portfolios face risks that are exacerbated with every further fraction of a degree of further global warming. So through our work with shareholders, investors, and other financial and corporate actors, we seek to bring companies into line with a pathway that achieves a stable climate future that is consistent with the climate goals of the Paris Agreement. And so that's where our shareholder proposals are coming from this year. So next slide, please, Co. Yeah, so our proposals this year, I guess, do escalate to the point of bringing the particularly transition risk elements of climate change into the boardrooms of the companies that we are focused on. So that's where we'll be presenting on today. Next slide, please. The proposals we filed this year in Japan, we have filed one proposal that covers at each of the 4 companies, and that is requesting disclosure of policies and practices that would ensure director competencies for the effective management of climate-related business risks and opportunities. So you may have noticed in the slides that Mr. Brochard was just taking us through, the TPI has some guidance and expectations around how banks in particular in that framework can demonstrate this board level oversight and competency when it comes to managing climate risk. So we'll go into the details of that in a little bit, but certainly one that is very prevalent and important for these 4 companies to be addressing. And then for the mega banks specifically, and this proposal is not being filed to Chubu because it focuses on really the bank's own commitments and commentary that they have already published, which is that they are committed to climate goals like net zero emissions by 2050, and the climate goals of the Paris Agreement, and that they plan to assess the transition plans of their banking clients to ensure that those companies have transition plans that are aligned with the bank's own climate goals. Unfortunately, we are not seeing the details required to be confident that the banks are conducting and will conduct these assessments rigorously and ensure that finance only continues to flow to those clients that have genuine Paris-aligned transition plans. And so our resolutions at the banks are looking for further disclosure around those frameworks to ensure that financing is being directed to the transition and not directed to activities that delay the clean energy transition. Next slide, please. So when it comes to banks' climate policies, Market Forces works on banks in Australia, across Asia, and some in the US and Europe as well. And it's very clear through all the research and policy assessment and also lending activity that we see that there are 3 key elements to a robust climate policy when it comes to banks, and all 3 elements need to be in place in order for those policies to ensure there aren't loopholes that allow financing to continue flowing to activities that are misaligned with climate goals that the banks say they are committed to. So The first element is clear project financing exclusions, so policies to end project finance for new and expanded fossil fuel projects. And this is an element that banks are generally this is the first area that they move on. And for the Japanese mega banks, we've seen that when it comes to financing thermal coal mining and coal power projects, those exclusions are in place already. There is then the targets for phasing out ongoing support for fossil fuels. And again, we are seeing these targets come in, particularly we're seeing 2030 targets for reducing financed emissions. Now, the problem with financed emissions targets or lending exposure targets or financing exposure targets is it leaves room for continued activity that enables projects or activities that are inconsistent with the trajectory of those targets and the pathways that are being that are attempted to be followed. Because, for example, you can finance a new gas power station that is opening tomorrow. You could reduce your exposure to that power station before 2030 and therefore meet your finance emissions targets because it's no longer on your books. However, the project is up and running and the emissions, the real world emissions that it would continue to generate are locked in for decades to come. And so that's where the third key element really comes in. And that is a requirement that banks clearly and comprehensively and publicly assess clients' business plans to ensure that those plans are aligned with a net zero by 2050 pathway and the climate goals of the Paris Agreement, and consequences for where those transition plans are not aligned with those goals and are not credibly going to shift the company towards a pathway that is aligned with a 1.5 degree warming outcome. And this can apply across the board to project financing, to general corporate purposes, lending, even to bond arrangement for general corporate purpose bonds as well. And so that is really the third key element that the Japanese mega banks in particular are lacking at the moment, and the one that is the focus of our shareholder proposals that is focused just on the banks this year. Next slide, please. So in the past, we have either ourselves or in support of and working with other co-filers, we've filed proposals at Japanese banks for the last 5 years now, dating back to 2020 at Mizuho, where we supported Kiko Network to file the first ever shareholder proposal focused on climate issues at a company in Japan. And you all know that it's now much more commonplace in those 5 years that shareholder proposals focused on climate in Japan are becoming much more commonplace. And we have been playing a role in that. Certainly the work we've done at MUFG in 2021, SMBC in 2022, and last year for the first time filing all 3 mega banks. Always on elements of those 3 key pillars, I guess, of a robust climate plan from banks. They have been the focuses of the shareholder proposals we've filed in the past. And again, this year, as I said, the bank's assessments of their clients' climate change transition plans is the focus of one of the proposals. But we also have, for the first time, filed a proposal specifically focused on director competencies, and I went through the details of that earlier, and it probably can articulate it a little bit more with respect to Chubu. So I might hold off on explaining that in more detail there and go to the next slide, please. So what we're seeing is the Japanese mega banks, as I said, they say that they are assessing their clients' transition plans, but that assessment process is failing at the moment. We know it's failing because the banks are continuing to lend to projects and companies that are incompatible with global climate goals and undermine our chances of reaching a 1.5 degree warming target. By contrast, we have in Australia seen both Westpac and Commonwealth Bank come out with more detailed client transition plan assessment criteria and disclosure. Those policies and disclosures are still not perfect, but they certainly go a lot further than where the Japanese banks are at, and put in place clear expectations of particular fossil fuel clients that must be met in order for those clients to continue receiving finance. So the Westpac example is a good one there, where they say, we will continue to provide corporate lending and bond facilitation where a customer has a credible transition plan in place by September 2025. And that relates to upstream oil and gas companies. And then Westpac goes on to sort of detail that a credible transition plan requires being developed by reference to the best available science, including scope 1, 2, and 3 emissions, and actions the company will take to achieve those reductions in line with pathways to net zero by 2050, consistent with a maximum temperature rise of 1.5 degrees. And so there's a lot of the key elements that are required to ensure that a company is genuinely transitioning to a 1.5 degree pathway encapsulated in that Westpac commitment. And that detail and those expectations are nowhere to be seen in any of the Japanese megabanks disclosures to date. So next slide, please. These gaps in the Japanese banks' policies are leaving the megabanks increasingly exposed to transition risk. We have seen last year, the data shows that Mizuho and MUFG take out the number 1 and 2 positions globally when it comes to lending to LNG. And SMBC is not too far behind in position number 7 globally. Now, we know that the IEA net zero emissions by 2050 scenario, which is the lowest cost, most technically feasible, most socially acceptable pathway to net zero emissions by 2050, consistent with the climate goals of the Paris Agreement. In that scenario, global LNG trade must decline around 50% by 2030. So this Japanese megabanks' failure to properly assess the clients that they are lending to is exposing them to this increased transition risk that this significant exposure to industries that must decline represents. And to spell that out in a little bit more detail, we can look at an example of a country like Bangladesh, where there are many Japanese companies and a lot of Japanese finance that is going towards new and proposed LNG import and gas power infrastructure in that country. Bangladesh is struggled to pay for and afford the LNG imports over the last couple of years because of the spike in prices post Russia's invasion of Ukraine. And what we've seen there is the volatility of LNG demand markets that can be expected to continue in a declining demand scenario where, as I said, global LNG trade is projected to decline significantly this decade. So for a Japanese institution that is exposed to projects and companies operating in that environment, there is increased risk of sovereign risk where governments step in and say, we are not pursuing those projects and we're shutting them down early because they are not viable for our country to continue importing LNG in that way, as an example. And just general default risk where we're seeing, again, the IEA has projected that in its 1.5 degree scenario, oil and gas companies stand to lose somewhere around 60% of their value. And so these are significant financial risks that the Japanese megabanks in particular, and compared to their peers, are taking on and maintaining a greater exposure to. Their directors are responsible for managing climate related financial risks and opportunities. And this is where, I guess, the second type of proposal that we filed this season comes in. Next slide, please. So you might recognize the first, I won't go through all of these in detail, but the first box, you might recognize some of the language as it's pretty much identical, I think, to the TPI's assessment indicators when it comes to climate governance. And the key ones here are from the Climate Action 100 Plus, and as I said, very similar to the TPI framework as well. Investors are looking for assessments and disclosure of directors' competencies when it comes to managing climate risk. And they're also looking for disclosure of details on the criteria used for the assessments and or the measures taken to enhance directors' competencies when it comes to managing climate risk. That is one example of multiple across the industry that investors are clearly demanding this and expecting this board level expertise when it comes to managing climate risk. Next slide, please. And as I said, this becomes really clear when you look at a company like Chubu. So the key metric here around metric 8.3A and 8.3B is what our resolutions are really seeking to encourage disclosure of. And that is to meet investors' expectations that the company has assessed its board competencies with respect to climate risk, and to provide detail of that assessment, including the criteria is used and the measures taken to improve. Chubu currently meets neither of those two guidance points from investors. Some of its peers globally meet at least the first. And so we need to see improvement across the board, but for Chubu in particular, we need to see a significant improvement. Next slide, please. I don't want to go into too much detail here, but it's no secret the scale of transition risk facing JERA. It is Japan's largest emitter. It generates 100% of its electricity from fossil fuels, and it sort of dwarfs even some of the what you would consider some of the biggest emitters of its peers. It makes theirs look relatively small in comparison. Next slide, please. And the story from here in terms of Chubu's plans and also JERA's plans. Chubu is a 50% joint venture partner in JERA with TEPCO, and really JERA provides an extra layer of climate risk exposure for Chubu that is not currently being appropriately managed and not being designed to align with global climate goals. And here we see the kind of pathways and plans that have been put in place for both Chubu and JERA, and how far misaligned they are with the net zero scenario, which is the 1.5 degree warming scenario of the IEA. But also importantly, they're significantly, the emissions reductions that Chubu and JERA are targeting are significantly less than what is required even in the IEA's stated policies scenario, which is just based on existing policies and only limits global warming to 2.4 degrees of warming. So the company's targets are not just falling short of a 1.5 degree outcome, but actually falling short of the expected business as usual declines that need to happen, even in a scenario where the goals of the Paris Agreement are not met and we reach 2.4 degrees of global warming. So all of this is just going to show that the scale of transition risk that is facing Chubu and JERA as it's the joint venture that it is part of, that is not currently being appropriately managed because the targets that are being set are not consistent with what needs to happen in order to make that transition to a decarbonised economy. So next slide, please. Just reiterating here the language of the resolutions and what is being asked for. I think that the rationale behind them I've been through in detail. I just wanted to touch on the I guess the significant increase in investor interest that we've had this AGM season in the build up to the AGMs, which will happen at the end of June. We've had a lot more investor engagement on these specific proposals than we have perhaps in the past. This is consistent on the bank's side with the client transition plan assessments, really consistent with our experience in Australia last year, where investors showed much more interest in these requests, which we put to both Westpac and National Australia Bank, NAB. Those proposals did get in the range of sort of 20 to 30% support. And yeah, a real sort of increase in investor interest compared to previous years' resolutions. And certainly the issue of director competency when it comes to managing climate risks and opportunities has sparked a lot of interest and conversation with investors that we've engaged with so far. And that engagement has been, it's been more, I guess, consistent and at a larger scale than previous years as well. So we're clearly seeing the indicators that investors are interested in and looking for these types of disclosures that are being requested by the resolutions. And I did just want to say that the resolutions are up on the UNPRI platform. And so investors can pre-declare their voting intentions through that platform. And that's a really useful way of demonstrating to the company that we expect these changes to, these disclosures to be produced, and investors have a keen interest in this. So thank you. That's all from me, and look forward to the Q&A later.
Thank you so much, Will. So I'll switch to Japanese actually from here. ありがとうございました。で、ここからは実際にこういう提案を受ける
Thank you
企業
so much. From now on, the companies who receive shareholders' proposal, the actual emitter, and they have board of directors. How BOD manages this transition risk, I'd like to invite Mr. Fujisawa from RectusPartners. He became independent from financial institutions recently, so please start with your self-introduction. So, Mr. Fujisawa, please go ahead. Thank you. My name is Fujisawa. As you can see, I used to work for asset manager. In other words, all of the audience who are here today, I used to be close. I was on your side. But today I want to talk about the situation, since we have a wide range of concerns and thinking of institutional investors. I'd like to share with you how our company views the current situation. Please go to the next page. So let's look at the differences between stakeholders in terms of how they understand just transition. Now, theme of this web seminar is not just transition, it's just transition. It has a wider definition, as a matter of fact. So if you look at just transition, the words, I'm pretty sure you know this phrase. But on the other hand, what does just transition mean? How is it related to the decisions made by institutional investors? You may not know a clear answer to this question. There are environmental aspects and social aspects that are included in the definition of just transition. The concept itself has been proposed by ILO. They were designed to generate social just as well as labor. And there are quotations from social paper. International organizations and different countries rather, have different understanding and different definitions of just transition. Just transition, as I said, was originally proposed by ILO, but if IMO or EU, they use the same words. But as they propose new policy, the specific content of that is completely different. In other words, they reinterpreted this concept. What is noteworthy, whether that is IMF or EU, they're not looking at the global just transition. The focus is more placed on economic growth. Whether this is good or bad, there is no answer to this. But when the concept is translated to actual actions, there is always this process of translation, and this is unavoidable. Now, if you go to the next page, what other countries are doing other than EU? This is a quotation from a committee of the Ministry of the Environment in Japan. Now, what are some of the proposals made? Policy proposals are made in different countries in this area of just transition. What is the size of funding given by the government and so forth? As you can see, starting with Japan, this is something that you know very well, so let me skip Japan. But needless to say, there is a Green Transformation Promotion Act. This is basically designed for supporting decarbonization effort within the country. Now, just transition is not utilized in US, but there are several that are related to just transition. There are 3 policies listed here in US. These are used for revitalizing domestic industries. Needless to say, this is not about global transition. It is more about economic growth within the country. Lastly, if you look at EU, this is the only case where just transition is the real focus in setting a fund. This just transition mechanism is to alleviate a social impact. In this way, as you can see, there are multiple policies that are related to transition. But many of them focus only on domestic growth or internal growth. Because the situation is a focus being placed on economic growth in just transition, as we try to promote just transition, as we discussed in COP28, commitment needs to be strengthened, as you can see in the example of global stock taking. Now, international organizations and national government are not active enough because they place emphasis on domestic transition alone. Take that as a fact. Now, I'd like to examine what investors are doing. It is more about how money flows, as you can see at the bottom of this slide. If you go to the next slide, in relation to the climate change, institutional investors are engaged with investee companies. They are looking at reports of the companies. So there's nothing I can advise. I just want to present some highlights that could serve as the foundation of the engagement. As you can see on the left-hand side, there are 4 circles. This is something you used to see a lot a few years ago. PCFD proposed 4 elements. These are the interrelationship of these 4 key elements. Now, the theme of this webinar is governance. Governance is most important. This is a really overarching concept, including all the other aspects. So when we talk about corporate governance, the key need to understand first as we try to discuss climate change. So with that understanding, corporate governance should not be limited to theoretical discussion. We have agency theory, shareholders and agents and managers. There is always information asymmetry that is taken for granted. Therefore, it is important to increase transparency of information that is given to shareholders. This will help reduce agency costs. That is the assumption. So that's the theoretical foundation. Now, with that, what do we ask for in terms of governance. So in terms of climate change, we have to minimize agency cost. At the same time, companies are asked to maximize corporate value. So what sort of information should be disclosed? ISSB, as you can see in the middle, this is what ISSB requires government to disclose. Not everything, but if you look at the very first point, that is the disclosure of governance or supervisory bodies or individuals that are responsible for oversight or monitoring. That's really the primary request. Whether the company can do this or cannot do this. If the answer is no, this is not up to the expectation of investors. There is no governance bodies that are responsible. If there is no way to identify a specific organization within the company, they will be at risk. If there is a system in place, the company should explain. If there is no system or organization like that, they should be quick in establishing that. Now, as you can see, this oversight body, does it have sufficient skills or capabilities? Climate change-related changes are very rapid recently. Even experts are having a hard time tracking down the changes that are happening in this area. I, myself, or our company, in this rapid changes, whether the organization has the capabilities is a very important question. But in what way this is provided as piece of information, it's hard to imagine how this can be disclosed. So I'd like to give you an example on the next slide. I have looked at all kinds of disclosures of different companies in Japan in order to ensure the effectiveness of governance. What do you need to look for? So this is a summary of leading examples. So this is not examples of all companies, but for your reference, you'll be able to utilize this information for your future engagement. Approaches can be classified, as you can see. Appointing external experts as directors is the most advanced case. So there will be more engagement, but appointing external experts as directors is not easy for many companies. The experts need to understand the business of the company and need to disclose the capability to monitor and manage. And climate change, should it be the only decisive factor to select directors? It's very difficult to find capabilities. The candidate directors who have both managing capabilities and the knowledge of risk assessment. So it may involve all the members of the board to be involved in the climate risk management. There is a large company headquartered in Nakano, which starts with M, or IT company which starts with R. These are some of the good examples that have taken this approach, appointing external expert directors. But I think more realistic choice is setting up an advisory board. External experts will be invited to participate in the advisory board so that they can communicate with board members on a regular basis, giving direct feedback to managers. So this is a mutual communication that will continue on consistently. And this will help external experts better understand the business as time goes on, and expertise can be fed into the company. What is good about this approach is different from appointing experts as directors. Actually, dismissal or selection will be much easier and flexible. If it's external directors, they will sit in the board for maybe 2 years, possibly as long as 10 years. Now, when it comes to climate change, you have to balance the business importance and climate risk management. Do we have to have a climate expert all the time? You may wonder about this. So you may want to set up an advisory board, invite external experts to this board to have mutual communication. But similar challenge exists, that is the lack of qualified personnel. But if it's a form of advisory board, multiple people can actually have multiple hats. So I think this is a more realistic, practical choice. Going down there, as you can see, some of the other options are pretty obvious. So I do not give you detailed explanation. Now, governance is widely discussed, but climate experts may be invited to the board meeting for board members to study. But if it's just a one-off event, it's not going to impact the business management. The lecturer could talk about external environment that won't be incorporated into business practices, meaning they may not be able to achieve the climate target. So essential discussion needs to happen for companies to accelerate a transition. So a company needs to have deep discussion as to how they should go about the real transition process. Please go to the next page. This is a very simple summary. I am repeating myself here, so I can actually skip this slide. And this is the end of my presentation.
Thank you very much, Fujisawa-san, for your presentation so far that we have discussing from the point of view of the companies and what are the policies that should be. That was well elaborated by Fujisawa-san. There have been a lot of information, so that together with Mitsui-san, that we would like to go into the summary of what we have discussed. In the slides that we would like to proceed with the question and answer format with Mitsui-san. Okay, so Mitsui-san, please play the role of the host. We have been discussing the role of the institutional investors and advocacy personnel and the companies, and what is the outcome of the sustainability has been discussed. And what will be the shape of the format of the companies? Mitsui-san. Yes, thank you very much. My name is Mitsui from the Nomura Research Institute, senior researchers. Listening to the presentation, it was very wide and deep, and whether that I should extract something specific from these discussions, I don't know. But anyway, that there are many companies, as you know, and very big companies and very ardent of that preventing of that global warming. Those small companies that want to do nothing about the global warming. Algirdas-san and Will-san, both of you discussed the banking businesses, especially Will-san. And you are proposing to the banks. And the bank, of course, is that the business entities and stockholders want that the companies to grapple with the global warming. Now, if that the mega bank is entity, they are. And as Wilson said, in Japan, the mega banks in Japan, compared with the overseas banks, they are investing into the companies that which may jeopardize the global the climate. And why? Why do they do such kind of risky things? That, as Algirdas-san says, that the bank's governance and skills, there is a lack thereof. Or one more thing is that they're explaining to the customers, the Japanese enterprises. Well, you know that we are focused on the activities of the Japanese companies, and therefore that they are hesitant to disclose the plan. The Japanese, so for that if those the hard companies be chased out of the portfolio, is it the answer? Probably no. That there are the non-banks they're giving the loan to the enterprises, that the mega banks they are committed verbally at least to commit to the global warming prevention, so that if they are in violation of these policies, they are outside of the radar of the companies, and therefore my point is that they are engaged on the companies, but sometimes the target schedules, the clear target schedule is not disclosed. Why? But the manufacturing companies, in the Japan Steel, that put forward of that the new business plans, and also that they are requested to increase the consumption of the renewable energy. And energy, the Japanese company says it would like to achieve the decarbonization, but it is so uncontrollable to them, and therefore it is very difficult to establish a plan. The Japan Steel says that depending on the cost of the renewable energy, that we cannot make that the specific future plan. That is, unless that the government policy is very clear, that the companies, they claim at least that they cannot compile the very clear policies. And that's the reason of the companies, and this is the same in Japan, and the same in the other countries. According to the seventh energy policy, among the foreign investors are sending the communication to the energy agencies, or that we have to be very more actively engaged energy agencies. So what the Japanese companies should do, not all the Japanese companies maybe, but more than 10 years ago, that they are requested of that the investors, and they put forward about a 3-year plan, the mid business plan. They can they say that they cannot disclose before that the midterm plan. That is understandable. And in 2020, Japanese government says that ultimately it will be the net zero. At least one time that each company produced the midterm plan. So significant size of the companies and hard to abate of the companies as the impact of the society. In the midterm plan, they include the decarbonization or the decarbonization business. Well, the temporarily that the disclosure is looks better. So the next 3 years, whether the Japanese companies can translate it into the implementation of the policy, and I think that we have to watch the next 3 years. So if they have the solid midterm plan with a very robust investors, the investor watch whether the implementation is very faithfully done. So that my hopeful, positive view is that in 3 years' time that they are going to see the outcomes, positive outcomes. Having said so, that ESG within the EU, that the Netherlands is advanced 10 years ago when the corporate governance started in Japan. And the Dutch investors said that I asked them that whether ESG is very active. The answer is that about 1/3 is the zero, lower than the zero of the land, so that the civilian activities is very, very active of the global warming, the preventions, and therefore that they are very close to them of the global warming, and therefore that they translate it into the companies for abiding by. But the location by, I don't know, but the normal citizens do not feel that much of the global warming. And from that 2019, there was a big typhoon, and so that extreme weather has started to bite on the Japanese the mind. So that overseas investors and Japanese investors really in earnest started to engage. And if the companies are established before the 2019, the companies cannot steer very, very quickly. Actually, that 2018, that the low carbon of the Japanese government, and that is really zero zero policy is necessary. Some of the company's employees said to them, but the 2018 there was really written nowhere. So that before that the disclosures, many of the companies started actually of engaging of that institutional investors. So Japan Steel, the same, and the J Power also, and many of the organization and ICC and also MacForce and citizens groups has been disclosing, and also that there is a trend among the companies to rather easily go into the zero carbon track. Well, I don't know whether that I responded well to your the question or not, but this concludes my opinions. Thank you very much. They certainly did. For the escalation of the engagement, my question to you is Exxon versus investors. Karpas said that the investors versus Exxon. So in Japan, well, there is the possibility of escalating of the proposals to the companies, but in the context, well, how shall we interpret or translate whatever is happening in overseas to Japan? Are you saying that, well, the U.S., as Matsuki-san said, that the article says, well, tomorrow there is going to be the general shareholders meeting, and the Kalpas is proposed of the opposed to all the investors, but itself is not directly related to the global warming, but the global warming is the original starting point. But there are two stakeholders of the proposals, and they sued by the Exxon, and the two stakeholders withdrew. But Epson is continuing with the court suing, and the Kalpas proposed that all the stakeholders to oppose the Exxon. I think that was a story for the managers of the companies. What is the right of the stakeholders, and the stakeholders, stakeholders' money be sent for the court or the lawsuit expenses, and some people are on the side of the Kalpas because of this. Other part, of course, that there are supporters of Exxon among the shareholders. Let me digress. I'm hearing, interviewing many people, are certain that the Northern Europe investors contacted me, and so that I sold that Exxon shares. So I cannot do anything about this. I don't know if this is good or bad. So the banks is a responsibility of the support of the society, and so that for the companies which are not ardent with the these CO2 decarbonization companies cannot be chased very easily, dumped from the portfolio. But going back to the questions, yeah, it is not that easy that the Japanese companies' policies or the countermeasures, yes, indeed, slow. But many of the companies, if it is impact on the business, well, many of the companies are hesitant, because it is the adversary effect of the business. Carbon tax discussion started this year, so the regulation is slow to follow. It will proceed, but anti-ESG, so that we have to, the withdrawal. No, I don't think this happens in Japan. And actually, the Japanese companies is slow to disclose because that I have mentioned, and they have the mid-term plan. Usually that the 3 years, that they stick with a 3-year plan, so that it is not, changed very frequently. When the pandemic started, many of the companies are expected to delay with the decarbonization. No, the opposite happened. Net zero policy was announced by the government during the pandemic. Really, the Japanese companies are pretty active of the decarbonization, and the U.S. companies are saying this is necessary for the business plan. and so that we should really respect that the intention of the shareholders. I think this is the trend of the United States and Japan, but it is difficult to propose the resolutions during the shareholders meeting. This itself has to be should change. Well, so that sometimes it's very difficult to change the code of conduct provisions in Japan, just like the United States, that the recommendation rather than the proposals of the resolution should be proposed. And so the shareholders meeting, the forum of the exchange of the opinions of the shareholders. So I think that we have to keep this forum for proposing of the shareholders. So whenever that I discuss the Japanese companies, yes, that some people, I always says that this is a very good chance for you to disclose. And with the proposals that actually that this is that the good chance of publicity of your company, be happy that the proposals is produced from the share stakeholders. I think that the shareholder active proposals of the shareholders is really that the bad thing in Japan positive. Thank you very much. In Australia, and there is the report of the global warming, and I think that 58% of the stakeholders said no. In 2021 was that, and 30 or more than the percent of the Exxon, as a UK rule, that the company says more than 20% of the recommendation of the board members. If it is more than 20%, that the company have to take specific measures. So in this sense, that I think the Japanese companies hope to follow this. So we are behind the time that we would like to move on to the QA session.
So the very first question, this is the English question. Let me read this out in Japanese. To Will and Brochard, question is about legal risk, especially institutional investors. With regard to climate governance, if they fail to engage with companies, legal risk, is it any legal risk on the part of institutional investors if they fail to have a dialogue with companies? Starting with Will-san, please. Will?
Investors have legal duties to manage financial risk on behalf of their clients and beneficiaries. So it's no secret the financial risks that climate change poses to both individual companies within a portfolio and the portfolio more broadly, with the systemic impacts that climate change is already having on economies, but threatens to have at an increasing scale with, as I said before, every fraction of a degree of further warming brings with it further economic risk and damage. But when it comes to the risks to specific companies or those companies' contribution to the systemic and portfolio-wide risks, then yes, I think investors do have a duty to manage those risks. And one of the key ways that they can manage they can, I guess, discharge that duty and manage that risk is ensuring that the companies that they invest in have appropriate climate governance in place and have appropriate transition plans in place to reduce their own individual climate risk exposure and their contribution to systemic portfolio risk. And I think there is also an extra layer of legal risk and duty here, which is for those investors that have their own climate commitments and climate goals and commentary around committing to active ownership for the purpose of delivering particular climate or social or environmental outcomes. And so where an investor has, for example, a net zero by 2050 commitment or a commitment to steward the companies within its portfolio towards a climate outcome, like the goals of the Paris Agreement, then they are on the hook for delivering on those commitments. And to fall short of pulling out all the stops and using all the tools at investors' disposal to bring companies into line with their own investors' climate goals. To have those commitments and not be doing everything in your power to live up to them amounts to greenwashing, and so that is also a further sort of legal risk and duty for investors.
ありがとうございます。アルキルダスさんにもお話をお伺いしたいんですけれども、こういう金融機関
Thank you very much. Also like to ask Mr. Algirdas, financial institutions are playing an important role in transition as well. If you look at UK institutional investors, to institutional investors, should we apply more pressure on institutional investors, lawyers and regulatory organizations? Are they applying more pressure on institutional investors, financial institutions?
In Pathway Initiative Center, we are an academic institution looking at the transition of companies to net zero. And so just specifically on climate-related risk and on the transition companies, we actually have also, if you're interested in these specific areas, in our framework that do look a little bit more into this, whether companies or banks include climate-related risk, both as a transition risk and financial risk as a key risk category. For instance, in their annual report, or if they explain the decision to exclude climate risk as a material risk category. So we really want to understand whether the banks do consider this risk for the investors. And then in terms of the transition that Will talked about, we also have an entire area dedicated to it in our framework that sort of evaluates whether the company does have plan to have financial conditions and or covenants to incentivize the transition of high emission sectors with companies. And so we see that the best in-class example really do have an entire process of engagement with companies to be able to engage with them on their plans and ultimately have an explicit policy set in place if after repeated engagement, for instance, companies fail to take actions. So if you're interested in this, you can find more details on our website. And then for investor-specific action, I can hand the floor back to you, Ko.
Thank you so much, Algirdas. And ここから日本語でお話しします。もう一つ質問ですね。もう一つ二つほど取
In
りたいと思い
Japanese,
ます。
one more question is here. One or two questions here. That the questions of Fujisawa-san and Wilson. So for the interest of time, I'm sorry that only post Fujisawa-san advisory board that you proposed and mega bank is many of the mega banks has advisory board body for considering that the feasibility that we have to have that the options are given to them for the risk management for the mega banks, the rules. Whether that we can get to the rules that they can have the specific ways for the risk management of mega banks. Can you have more specific policy that which is adaptable to the mega banks? Thank you. Yes, indeed. The risk management of mega banks, well, in this, that, well, maybe that you are very close to the institutional investors in the framework of the risk management. And one step, you look at the disclosure. If it doesn't make sense, that you try to get the appointment for the dialogue with the banks. And this time, the mega banks, I think that they will not decline to discuss with the shareholders, if you're the shareholders, so that you be very ask for the sincere explanation. That is the first point. Whether the risk management is very well done or not. Sustainability Advisory Board is not only the one of the board members meeting, or that it is very, very close to the decision making of the executive side of the company, so that they are doing well, but sometimes they cannot disclose, they cannot explain. That is a possibility also. So if it is the case, ultimately, well, how much of the trust that you can create it is the key factor. Well, so that whether that you have that the environment of the constructive dialogues, and whether that they can sustainably maintain that the possibility of the capability to interpret that even if you do not see that the disclosure that you cannot understand, and so that this is the banks is no good, that wouldn't serve anybody. So that we have to step forward from each side, and that is a first step. And the last question from the Mitsui-san.
Now to you, Mitsui-san, about climate governance. What does regulatory organizations do? This has been discussed globally. You have met many people across the globe. So the question to you. I never expected this question asked. I was thinking that you would ask a question on shareholders' proposal. Well, you can answer that question too. So about governance, first, climate change. I'm not sure whether I'm answering this question or not, but climate information disclosure, the governance has been defined within this climate. TCFD is a good example. Traditional governance has been like this. So companies set up sustainability committees. They talk about governance within sustainability committee. And this is pretty common in Japan. And they say this is the responsibility of CEO. This is the CEO of whole BOD. To get that stage, it takes some time. Maybe the things are the same initially in other countries as well. So this is the difficulty in dealing with sustainability. So you invite experts. In the traditional governance, you have to include this climate as a core part of that. Especially Japanese companies are trying to reflect the effort level to remuneration. But this has not been done well because they think this is the responsibility of board members. So the government that regulate this aspect need to ask companies to incorporate governance more deeply into the core business. So then lastly, our Japan had a lot of investors saying that the proposals made and the change of articles of incorporation will take place. If this whole process is smooth, well, it's not just climate change, but do we still have to change the articles of incorporation to make sure that shareholders' proposal work? Well, my understanding is that shareholders' proposals are free to be submitted. Wataru Tanaka said that I think it is possible to present a recommendation along with the proposal. And there is an investor who sent a shareholders' proposal to Toyota and appreciated that offer has been adopted by Toyota. But in Japan, according to the company's law, shareholders' proposals are only limited to the changes of the articles of incorporation. So they asked for the change of the articles of incorporation. and the companies may decline that. But if you have a dialogue and engagement beforehand and asking the companies to incorporate their recommendation as part of shareholders' proposals, if the companies are willing to accept the shareholders' opinions, if lawyers, some of the audience are experts in that area, maybe we actually promote this process of inviting recommendations from the shareholders. And perhaps we should revisit how we deal with this, the articles of incorporation. The change in the articles of incorporation is not easy. And that is why we limit what is described in the articles of incorporation. There should be a statement that actually describes the policy of the company. And that should be the target of discussion between companies and shareholders. Now, advisory was... Should it be an option in the future if you could talk about that? Wilson, please.
Yeah, look, we have filed shareholder proposals now in 4 different markets, and each one has a different approach. So in Australia, we can only file an advisory proposal if we first file a change to the company's constitution that would allow advisory proposals to be put. And so the two go to the meeting together. That's not an optimal situation. In the US, it is much more straightforward for a shareholder advisory proposal to be filed, although it is so much more common, I guess, in the United States that it's actually quite difficult to get the attention on those shareholder proposals that we might see in somewhere like Japan, where it is a less common approach. And then the UK is probably one where we found it the most appropriate sort of model that we were able to follow for filing shareholder proposals. No one has the perfect system in place. The important thing, I think, is that the issues that are raised through a shareholder proposal are elevated in investors' minds and elevated through the executive and to boards of directors to ensure that the issues are addressed in the company's behavior and policies, regardless of the process and the differences between different markets. Certainly, if there were a common approach that made it really simple and easy for investors to have their say and use their shareholder rights to encourage action from a company that is in shareholders' best interests, that would be great. But ensuring that all markets sort of adopt something like that is not something that we're going to wait for in order to continue trying to have an impact through these interventions.
Thank you so much. ということで、だいぶお時間も迫ってきているので、そろそろまとめていこうかなと思うんですけれども。
We are almost out of the time that we have to summarize. In the questions, I'm very, very sorry that we don't have too much of the time for the questionings. But if you have a very compelling questions, or probably the study meeting, Mitsui-san and Fujisawa-san, Algirdas-san, that he discussed from the UK, which is a very the good opportunity for us that we have these experts, and so that if some person that on the chat says that he would like to convene the study group with the experts like you, 4 experts we have, I'm sure that the 4 experts will be willing to talk with you, including myself. Thank you very much for defining your very busy schedules, especially that the shareholders meetings are coming very, very close. So you must be very, very busy. So that I would like to, so 1.5 hours that we have discussing, that I would like to summarize from my side. So 2-3 minutes, wrap up. So hour and a half, Australia and London. Thank you very much, Algirdas-san and Wilson. Thank you very much for the participation. And also that we have 1 month to go for the shareholders meeting. Please read that Fujisawa-san's articles, Mitsui-san's articles, and please prepare that the shareholders proposal. I'm sorry that we are out of the time, so that we have to conclude. This concludes our webinar meeting. Thank you so very much for your participation once again.